Welcome to This Explainer. Today, we're diving into insights from Martique Finance to demystify, honestly, one of the most frustrating financial contradictions out there. Have you ever been watching the evening news, seen reports of widespread job losses and economic devastation, only to have the very next segment cheerfully announce that the stock market just hit a record high? It feels completely backwards, doesn't it? It makes people feel like the system is fundamentally broken or just totally disconnected from reality. Well, today we're going to break down exactly why this happens, and I promise you, by the end of our time together, this great market paradox is going to make perfect sense.
All right, let's just jump right in and look at April 2020. In just 2 weeks during that month, 2 weeks, a staggering 22 million Americans lost their jobs. The economy was quite literally shutting down in real time. By any metric, it was the absolute worst economic collapse since the Great Depression. Everyday folks were losing everything, businesses were shuttering their doors, and panic was palpable everywhere.
But here is the kicker. In that exact same 2-month window of extreme, very real economic pain, the stock market went up 30%. Yeah, you heard that right. Down 22 million jobs, up 30% in the market. It's no wonder people felt like Wall Street was popping champagne while Main Street suffered. But believe it or not, there's actually a completely logical mathematical reason for this behavior, and it all comes down to how we define the system.
It all boils down to our golden rule. The economy is not the stock market. Treating them like they're the exact same thing is the root of almost every financial misconception out there. Think of it like this. The economy, it's basically a backward-looking weather reporter. It tells you what yesterday's temperature was using past GDP numbers and last month's unemployment figures. But the stock market? The market is a forward-looking meteorologist trying to forecast next week's weather. It really doesn't care what the profits are today, it cares what those profits will be in 6 months, a year, or 2 years from now.
This perfectly captures the wisdom of legendary investor Benjamin Graham, the guy who actually mentored Warren Buffett. He famously pointed out that in the short run, the market is a voting machine, reflecting emotion, fear, hope, and panic. But in the long run, it's a weighing machine, reflecting actual underlying value. When a real crisis hits, that voting machine starts behaving in some deeply counterintuitive ways, looking right past the current disaster.
To understand exactly how that voting machine works during a massive crisis, we're going to break down 5 specific reasons. Reason 1, pricing the future. Remember, markets do not care about the present. Imagine a company that makes restaurant equipment during a harsh recession. Restaurants close, sales collapse, and the current economic data looks terrible. But investors aren't asking about today. They are asking, will this company still exist in 2 years? If the answer is yes, they'll start buying that stock before the economy actually gets better.
In finance, we call this discounting the future. Investors aren't fixated on today's closed restaurants. They're buying stocks based on whether that company will survive and thrive years down the line. Stocks are priced on what investors believe the company will earn over time. So, ironically, when things are at their absolute worst and people start to believe the worst is finally over, that's exactly when markets pivot and turn around, even if the unemployment lines are still growing. Moving on to reason 2, the S&P 500 is not Main Street. This is really a matter of scale. That stock market index you see flashing across the news ticker every night, it does not represent the local businesses in your neighborhood. When news anchors say the market is up today, they almost always mean the S&P 500, which tracks the 500 largest companies in America. A recession might absolutely devastate the local dry cleaner or the family-owned restaurant on Main Street, businesses that, by the way, employ nearly half of all U.S. workers. But the S&P 500 is made up of global giants like Apple, Amazon, and Microsoft. These massive corporations draw roughly 40% of their revenue from entirely outside the United States. They sell iPhones in Europe and cloud services in Asia. So when a localized U.S. recession crushes Main Street, these global behemoths are heavily insulated, which keeps the overall stock index afloat.
Then we have reason 3, the power of the Federal Reserve. During an economic downturn, the Fed can step in to stabilize things. They do this by pumping incredible amounts of money into the financial system and slashing interest rates to essentially zero. When they do that, safe investments like bonds start paying next to nothing. So what happens? Money rushes right out of bonds and pours into stocks, because stocks suddenly look like a vastly better bet. Plus, those cheap borrowing costs heavily boost corporate earnings.
Wall Street has a catchy name for this dynamic. They call it the Fed put. It's this implicit belief that if financial markets fall far enough, the central bank is just going to step in and rescue them. Because this belief is so deeply ingrained, investors actually start pricing in a multi-trillion-dollar rescue before it's even officially announced. The real economy might be collapsing around them, but traders are already bidding up stock prices because they know the financial cavalry is on the way. Now for reason 4, markets hate uncertainty, not bad news. This one is deeply psychological and honestly surprises a lot of people. The reality is, markets don't actually hate bad news. They hate uncertainty. They don't go into free fall simply because the headlines are terrible. They crash because literally nobody knows how bad the situation will ultimately get. It's the sheer terror of the unknown that triggers massive panic selling.
Take March 2020, for example. The VIX, which is often called the fear index, hit its highest recorded level in history. Why? Not just because the initial economic data was bad, but because the bottom was completely unknown. No one knew how long global lockdowns would last. But here is the secret of the market. Once the shape of the disaster becomes clear, even if that shape is an absolute tragedy, investors can finally calculate the risk, plug it into their models, and start buying again. Bad news is measurable. Uncertainty is not.
And that brings us to reason 5, the reality of wealth distribution. This is based on entirely objective data straight from the Federal Reserve, and it perfectly explains why this market behavior feels so profoundly alienating to the average worker. When the market booms while the real economy struggles, who's actually feeling the tangible financial benefits?
Looking neutrally at the numbers, stock ownership in America is highly concentrated. A massive 89% of all stocks are owned by the wealthiest 10% of Americans. Meanwhile, the bottom 50% owns just 1%. That means when market rallies happen during recessions, the wealth generated flows almost entirely to people who are already financially insulated from the initial economic shock. It's a purely statistical explanation for why a booming stock market just doesn't equal a booming economy for the vast majority of citizens.
So, let's see how all of this comes together. We're going to apply these 5 reasons to a 2020 case study to really prove the theory in action.
If we look at a strict timeline, in January and February, markets were hitting all-time highs. By late February, virus reports caused a freefall. But notice how the market famously bottomed out on exactly March 23rd. Why that day? Because that was the exact day the Fed announced unlimited quantitative easing. The shape of the crisis became clear and the Fed put was activated. That forward-looking meteorologist behavior allowed the market to shoot up 25% through April and May, even as backward-looking data showed unemployment hitting a devastating 15%.
Now, it's really important to point out that markets do not always snap back instantly. Unlike 2020, where rapid Fed action clarified things quickly, look at the 2008 financial crisis. Stocks fell for 17 agonizing months. Why the difference? Because the deep uncertainty about whether the global banking system would even survive just dragged on and on. The shape of the crisis refused to clarify, which kept that fear index sky high and stopped the forward-looking market from safely pricing in a recovery.
So, where does this leave us? The stock market is a brilliant, highly sophisticated machine for pricing future corporate profits. It really does do that exceptionally well. But it leaves us with one vital question. If the stock market recovers, does the recovery reach everyone? The honest truth is, not automatically, and certainly not equally. A rising S&P 500 doesn't measure human recovery. It doesn't guarantee rising wages, and it definitely doesn't measure the health of our local communities. It measures corporate futures. Understanding that vital difference is absolutely crucial to unlocking the great market paradox. So I'll leave you with this to chew on. What do you think would happen if we created an index that actually tracked the health of Main Street? Something to think about.